Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today I'm joined by our two co-heads of G10 FX strategy, Brian Daingerfield in the US and Paul Robson here in London. Paul, I'm going to start with you because at the very start of this week, we had a surprise coming from the European parliamentary elections where there was a shift to the right. And the big surprise was really French President Macron calling a snap parliamentary election in its aftermath. Paul, what did you make of these political developments?
Yeah, I think the key takeaway at sort of just one level is that this was just a big surprise. I think not necessarily the move from, well, in the EU elections to the sort of right. I think that was generally predicted in the polls, but I think it was the distribution of that move. In certain economies, the core countries like France, like Germany, you had a bigger move to the right, and this has just had consequences. And you know that even that move to the right in France shouldn't in itself have been a big market mover, but it's the reaction of President Macron to call an election that brings uncertainty to the outlook, because there wasn't meant to be a change in sort of Parliament until 2027. So it's brought this more immediately into focus for markets, and that matters. So calling of election, new and important information, and the euro has reacted to that. The main worry, I think, is what it means for policy at both a domestic and sort of pan-European level, because the right are doing particularly well in France, and you have this potential to have a split between the presidency and parliament, very much like we might be talking about the US election come November. So this cohabitation. And when you get a mix of political views between the presidency and parliament, you get political gridlock. And that's not great for France and the outlook, but also the EU, because France is such a central part of that as well. So big and important new information that needs to be digested for markets over through to July 7th election results.
Yeah, and I was really surprised just at the extent of the euro's reaction. I always think the euro kind of trades as oblivious to political risk, but it certainly didn't seem to on Monday. You know, looking forward, do you think this political risk will really continue to weigh on the common currency?
Yeah, I think so. I mean, it's very interesting you were saying about how political risk didn't seem to be moving the euro, and nor has it over the last couple of years. And you're exactly right with that. But before COVID and the European energy crisis, the currency was seen as being a liquid proxy, very sensitive to domestic politics in the core countries about euro breakup risk. And one of the key takeaways from COVID and the European energy crisis was this idea that Europe was better sticking together than fragmenting. And that meant the euro area, or the euro's risk premium, went down to zero. But the calling of this election, I think, sees that political risk premium rise, and that's why the euro has weakened. And I think you can see this on two levels. One is domestic policy in France, where you get a right-wing parliament where you have more populist parties, protectionism, potentially on immigration. Not that they can do a huge amount on that, but they can try and pass big, larger deficits. And this comes at a particularly important time because France, like a lot of developed market economies, is struggling with large deficits. And then also just on a more pan-European level, one of the things that we set out back in November for our year ahead was this idea that Europe was being squeezed by China on one side, potentially exporting excess capacity. On the US, you've got a retooling of the manufacturing sector, and Europe needs a policy response, and that needs unity. But if you start getting fractions within the political landscape at a national level, then that translates into issues at a pan-European level, and that matters. So I think the key takeaway for me is that return of the risk premium, which it will ebb and flow, but I think it's now back. And it means whatever you thought the profile for euro dollar was going to be over the next sort of 6 months to a year will now be lower than it was previously. And, it's been a very important week for the euro and leaves it weakening through this political risk premium.
Europe, or the Eurozone, isn't the only place in Europe to have political risk. We've also got a parliamentary election coming up here in the UK. What are the latest political developments regarding that?
Yeah, it's certainly been interesting, hasn't it? We weren't expecting a parliamentary election in the UK or France. The election here in the UK was penciled in by a lot of people into November, and it's obviously come earlier. As I said earlier, the French presidential election, parliamentary election, wasn't meant to be until 2027. So all of a sudden, we've got these two important elections. But I think the French elections are more important than the UK. We don't think that it's going to be market moving for the currency unless you get a significant narrowing in the polls, and the impact on the currency might be non-linear. You might have to have quite a big move in the polls before it starts having an impact. But the polls have been relatively stable. We've had the manifestos being released. There wasn't a huge amount of surprise. And that's consistent with our view here at NatWest that the key takeaway is one of policy continuity. And so we shouldn't expect a huge change in policy. I actually think next week's Bank of England meeting, or specifically inflation data, I think are going to be much more important than the election. That said, when we've spoken to clients further away from the UK, there has been this worry expressed that a big majority for a left of centre party might mean larger fiscal deficits. And people remember what happened a couple of years ago when we had trouble within the gilt markets. Now, we don't believe that's a worry. We think that the red lines that were drawn by the markets back in 2020, that means that we won't be getting bigger deficits. But it might mean that sterling has to wait until the first major fiscal event, a budget, potentially coming in October, to fully see the negative worries priced out of the market. So on balance, we see the UK, after 5 or 6 years of relative political instability, suddenly looks like an island of political stability. And I think that plays positive for sterling against the euro, why we watch the polls on the continent.
Very interesting that you say that, market participants still think in those terms of a left-wing government is going to be massive fiscal spending, when that's could not really translate into practical terms. Brian, the US was not one to be outdone by Europe this week, and we had a lot of US data events on Wednesday yesterday. The big one was US CPI, which came out lower than expected, and the dollar definitely reacted, trading sharply lower. What was so significant about this print that really caused that dollar sell-off?
Yeah, thank you very much, Eimear. We're talking all about political risks really across the world, not just in Europe, but also in a lot of emerging market economies. That was certainly the focus of our podcast, last week. But we're going to have our own political issues here in the U.S. coming up as we head into the autumn, into November. But in the near term, the U.S. is still all about the growth in inflation data and also relative rates and relative policy that we know tend to drive currencies in the short term. And so the CPI and the PPI, the big inflation readings that we got this week, in both cases surprised pretty clearly to the downside. And now the dollar's sort of been whipsawed a little bit over the last couple of sessions because the non-farm payroll, the employment report that we got on Friday, was notably stronger than expected, both in terms of headline job gains as well as average hourly earnings. Both came in a bit stronger than expected. So that sent the dollar rallying against major currencies. More recently, we've had the CPI numbers that came in softer. For me, I think the more interesting, maybe not more interesting, but certainly an important wrinkle into the CPI and PPI numbers we got is where the slowdown came within those numbers. So not only did we get below consensus expectations, but we also got slowing in what we call core services, excluding housing. So this is something that we know the Fed has been very, very focused on, this idea that goods prices have already shown clear signs of coming lower. In most surveys, goods prices on a year-over-year basis have already been negative. Really, where the stickiness has been is in services. And not just in non-housing services, but also in housing services. And what the Fed's been telling us for a few months now is that if you look at private sector indicators, for the most part, those are telling you that it's likely that housing related inflation is probably going to come down in future CPI readings. So one thing that the Fed has been really focused on is core services, excluding some of these housing measures. And that's really where you saw some of that weakness come through. These core services inflation prints came in noticeably lower in this month than they certainly had in previous months. We started the year with inflation pretty clearly surprising to the top side. A few months ago, we were certainly a bit skeptical of whether or not that could be sustained, whether or not there were some earlier impacts impacting the inflation numbers. Certainly the number we got this week may lean into that idea that maybe the disinflation progress continues, albeit still on a bumpy road. And so it's not just that the inflation numbers came in a bit softer than expected, it's also where that softness came through in these core services that we know is so critical for the Fed, which is why I think this number is so important.
And then only a few hours later, after that US CPI print, we got quite a conflicting message actually coming from the Federal Reserve meeting, where the dollar actually retraced some of those moves. Why did the market really see this Fed meeting as so hawkish?
Yeah, so you're exactly right that the market's initial reaction to the CPI was effectively upended by what we heard from the Fed just a few hours later. And, I don't think we heard anything that I would consider dramatically hawkish relative to what I think the baseline was coming into the report as recently as Friday. But I think the scale of the CPI surprise certainly led the market to think that this could be a moment where the Fed takes a much more clearly dovish turn. Effectively, you think about when you have an improvement in inflation in all the ways that the Fed is looking for, this could have been an opportunity for the Fed to sort of spike the proverbial football, if you will, when it comes to showing a bit more confidence in disinflation pressure. Maybe saying, the recent numbers we have seen as recently as the May press conference, Powell was asked a lot about whether or not the Fed would have to consider hiking rates again. You just remember where we were just a month and a half ago, thinking about the prospect of very high, much higher than expected, stickier inflation. Now we've seen a couple of months where progress is a little bit more obvious, where some of the labor market data have not been as extremely strong as we saw at the start of the year. Maybe this was an opportunity with rates sort of pushing to new range lows and the dollar on the back foot after the CPI, maybe an opportunity for the Fed to talk a little bit more confidently about disinflation and maybe about the possibility of easing policy rates later this year. But instead, they rejected that opportunity. And instead, the Fed's projection for the Fed funds rate, the dot plot, which gets a lot of focus, the median projection for the end of this year went up to show just one interest rate cut this year rather than the two that I think was expected in the market. The March plot showed 3 cuts this year. I think most were expecting that to move up to just 2, but instead the median moved up to 1 cut this year. And Powell was asked at the press conference whether or not the dot plot had a bit of a mark-to-market issue where, because the CPI came out just a few hours before the meeting, whether or not there was ability for members to change their dot plot. And he made it clear that members had the opportunity to change their outlook for the end of 2024 based on the CPI if they felt it was warranted, but that effectively they did not. And so I think the message from the Fed was very consistent. The Fed told us something that was very similar to what they told us in May. The difference between May and now, however, is that the data have generally moved in the Fed's direction, in the direction of easing, but the Fed continues to effectively slow play this. And so I think the reason why the dollar snapped back is because the Fed had an opportunity to really run with this disinflationary narrative, maybe push a little bit further in the direction of optimism. But instead, I think they've kept their cards really close to the vest. And at a time when a number of G10 central banks are approaching the start of their easing cycle or already begun their easing cycle in the case of several, that was, I would say, a pretty hawkish interpretation. Now, to be fair, I think the Fed is going to be watching the data. And the data they saw this morning, if you get a couple more prints like that, they're going to be singing, I think, a very different tune. But this was an opportunity I think the market was looking at after that CPI data, maybe an opportunity for them to sound a bit more dovish, and they decided not to go that route.
So I guess on one hand, we've got dovish US inflation data, a relatively hawkish Fed. Where does that leave the outlook for the dollar?
Yeah, we came into this week thinking that the dollar could remain choppy here, with a number of different drivers pushing, pushing the dollar in different directions. As Paul mentioned rightly, the outlook for politics in the euro area has certainly clouded the outlook a little bit and increased downside risk, or at least sort of increased political risk premium for the common currency. You also have the impacts of prior elections in emerging markets has really resulted in positioning clearing across emerging markets, which in a lot of cases has been positive for the dollar. In the G10 space, the dollar continues to be the high carry currency. And because it has very high interest rates and the Fed sort of remains at the back of the pack in terms of easing. And so what we've been thinking on the dollar is it's going to take consistent weakening in US economic data to really allow for interest rates to start to diverge against the dollar. Because what we've seen, generally speaking, is that interest rate curves have priced together when you have weaker readings in the US. What that's meant is that the market's pricing dovish outcomes across the G10. So you're pricing in more dovishness potentially from the ECB, more dovishness from the Bank of England. And in the vice versa, when the U.S. data were coming in stronger at the beginning of the year, we were pricing out a lot of that dovishness potential from other central banks as well. And so these interest rate differentials really haven't been moving all that much because the market has been pricing these curves, rightly or wrongly, pricing them very similar. So what we think you need to get the dollar to sort of break out of these ranges to the downside is consistency in this weaker data. Now, I think what you've seen over the last couple of weeks is maybe the first step in that process. Certainly the most recent CPI data, which I think is more important than the Fed, did come in softer. But in order to get that kind of interest rate divergence, I think you would need to see that data both continue and much more clearly slow. And the case for inflation to continue to slow, I think, is pretty good. On the employment side, maybe a bit more mixed. And so I think we're continuing to look at a pretty choppy outlook here for the dollar, where I think the outlook is going to be pretty clearly dependent on the data. But you're also running against not just the data, but also against the prospect of positioning clearing in after a number of major elections, and also some additional political risk premium to focus on in Europe as well. So we continue to think it's going to be a choppy outlook here. But if the data continue to slow, as we saw in the CPI number that we got this week, that's something that I think is a pretty important consideration in terms of potential weakness in the dollar down the line.
Guys, that's about all we have time for today. Thank you so much for joining me. If you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again.